Hey everyone, I'm Sean Smith, managing partner at Search Fund Ventures, and today I'm joined by Elliott Holland. Elliott's got great background and track record in supporting searchers and other acquirers with quality of earnings assessments and other deal diligence. So he's been generous enough to give us some time today. And Elliott, I'll let you give background on yourself and Guardian.
Yeah, absolutely. Thanks for having me, Sean. So, reformed engineer, Harvard MBA. I actually worked in a search fund before my 2 years at Harvard and got into private equity after HBS. Kind of realized early that owning equity was more important than working for people who represented the equity of pension funds. So I moved into the spot of an independent sponsor. And then I was super early as a self-funded searcher back in 2015. I'm back when Live Oak didn't even do acquisition loans through 7A. So I transitioned the skills that I earned into Guardian because I kept seeing what I call fake gurus, former digital marketers and media company owners start how to do an easy deal with no money down companies. And I knew how complicated and wrought with fraud, nefarious behavior, small deals really were. And so I started Guardian to be a guardian against primarily first-time buyers, but truly anyone moving from any other walk of life into small deals, which I call under $10 million, making sure they didn't get their head knocked off, to be honest. And so now we've been in business 7 years now. I would say I'm the best at sort of small deal QoEs, particularly if there's hairy components of the deal, and really where the differentiation is sort of being a deal professional, managing an accounting team. I'm able to bridge the gap between accounting and deal speak, um, and understanding how to answer questions from my clients in ways that they can make decisions in a way that's really tough for others to match because of their lack of experience.
That's great. Maybe just for the folks who are kind of less familiar with quality of earnings and all the other sort of advisory services you provide, can you kind of just outline, what that quality of earnings, what's the purpose of a quality of earnings, generally speaking, and then what else do you do kind of surrounding that core, report that you'll deliver to folks?
Sure. So let's have some fun. Let's first explain why it's even important. So a lot of folks come from like $100 million deals where you get like a Harris Williams, pristine 40 or 50 page book. You got super clean financials down to the penny. You got a management team with a real accountant on the inside, typically doing a CFO role, a controller potentially. And so when you get that book of information, you can somewhat believe it directionally because the reputation of some of the people who have touched this on the way to you, they are esteemed people who a 5% mistake is something that got up to the market can be very impactful to them. Well, what's the regulation on private company financial presentation? Not a gosh darn thing. And so when you get out of the Harris Williams, the top middle market investment banks books, that was sort of as you pass that stop on the road, that was the last time anybody of reputation touched the deal. And so your $5 million, $10 million, $15 million deal sometimes has had no real adults touch the financials. So how do you make $1 million decisions in an environment where you can't trust the financials? Well, you would typically get an audit. Now, people tend to know what an audit is. It's basically managing the fact that you want to present financials in GAAP. Quality of earnings is not that, but it is a mini audit specifically for buyers of small businesses so that they can straighten out the financials and make a true financial decision. And so the same kind of concept of an audit, comprehensive, detailed, lots of questions with management, is the same kind of thing you get in the quality of earnings. And really what you're doing is you're saying, hey, I may not have perfect financials historically from the target, but with this quality of earnings product, Guardian or someone else can straighten out these financials, put them into a GAAP standard, give me a real view, a conservative view on cash flow so I can make a decision. Essentially what you're solving for is John's HVAC shop said they're doing $2 million of EBITDA and they got wonky accounting, don't account for inventory well, haven't done an inventory account in 3 years. Well, the reality is those kind of things can swing profit substantially. So by the time you get the quality of earnings, maybe it's $1.7 million of EBITDA. And now all of a sudden you have grounds to renegotiate. You have grounds to at least understand what you're buying if renegotiation isn't the most important thing, or maybe you change the structure of the deal. And so as an investor who might not be leading the deal, the quality of earnings is your safety blanket, because honestly, the deal leader, sponsor, self-funded searcher has some incentives that the quality of earnings checks for an investor, meaning that person will get paid at closing and post-closing amounts of money, even in a downside case where the investor could get wiped out completely and have less knowledge of the asset. So a little bit long-winded, but I wanted to kind of hit it from the angles that I thought investors could understand.
Yeah, that's a brilliant explanation. And I think, there's two important points that are worth highlighting out of that. One, making sure that that quality of earnings is unbiased, right? So we've seen deals here and there where folks will conduct their own quality of earnings and, tend to not like that, especially when there's a transaction or a diligence fee associated with it when the deal closes. So like you said, you can follow a dollar on how, and how it gets paid out and when it gets paid out, and you can really start to understand, where incentives are going to be. Why don't you quickly talk about, how are the incentive structures really well aligned for someone like yourself and for quality of earnings providers in general?
Sure. Let me touch on the self-perform QoE. I have private equity clients, independent sponsor clients that have been doing deals for 20 years that don't do their own QoEs. Could absolutely do them, but what they tell me and what you should know is I'm biased in my deal. And so I shouldn't trust myself. And when these searchers, buyers are going from 6-figure salaries to 7-figure ownership, nobody should trust themselves in that transition doing this kind of analysis themselves. And then frankly, finance knowledge does not translate one for one to accounting knowledge. And so therefore a lot of smart iBankers, consultants that know finance think they know accounting, but have never done debits and credits in QuickBooks. And so therefore they're outside of their lens. And so in terms of incentives align, I am an unbiased party. I get paid by my client to do an audit-like product. We don't do contingency work, which means I have a higher incentive to tell you the deal is either completely wonky or off by 20%, knowing that may lower the chances that a deal gets done, but it doesn't impact my payment. That's why it scares me when QoE providers rather do contingency work, because it actually skews one of the most important incentive alignment scenarios. And so for instance, people get happy, they'll push the fees to closing, not realizing a lot of times when I have to do my hardest work, it's when I get to the end of the quality of earnings and I get to a number, but I could think of 5 things that could sway that number 50% of EBITDA. And so what I have to tell my client is, hey, the numbers came out to $1 million, but here are 5 things that could swing it down to $500,000. And so the financial set is not reliable. That's going to be probably 2 hours discussing with the client, another 3 hours discussing it with the seller, another 2 or 3 hours of analysis to then likely impact the likelihood of a deal getting done, which is good for you as an investor, Sean. And you'd love to hear that happen. But if I have an incentive for the deal to close, do I not lean into that as much? And then frankly, the kiss of death in the quality of earnings is when this statement is set. We could only rely on the data that we were provided, much of it provided by the management team or the sellers. We suggest you get an audit. When you see that in the quality of earnings, what that's saying is we didn't get to the finish, but we didn't want to publish anything nasty, so this is how we captured it. So something else for investors to look for in these reports that you see.
Yeah, great tip. And to your point, as an investor, the quality of earnings report is when it's done by a third party, when it's truly unbiased, is one of the, I would say, most critical pieces of the diligence process that we'll look at and rely on every time, to the degree that we can rely on it, outside of the non-reliance language and all that.
And I don't want to kill the whole report because of the non-reliance language. What I would say is each one of my reports has disclaimers. Like I can't be on the hook for $10 million and you paid me $25,000, right? That's unfair. But when I say in bold, I only had this data, you may want to get an audit, that's when my client would not allow me to publish a certain piece of analysis that would have looked wonky. And after fighting with them for a while, that was the way I solved it to limit my liability. And so as an investor tip, I want to give that to you guys. The other thing to look out for, frankly, and Sean, we talked before the call, so I'm kind of going there, but
Yeah.
I've seen a lot of my competitors' stuff. And being a former engineer and kind of understanding what data sets can and cannot tell you and what the rigor of analysis can and cannot tell you. And then being in the deal game and now the QoE game, a lot of times you need to be careful around, is the buyer that you're backing sufficiently capitalized to pay for a full comprehensive quality of earnings? Because what happens is if I'm watching my own pocket as a buyer and I say, hey, I can only allocate $15,000 to this because I can only stand to lose it, and maybe I lose it on this deal, need to cough it up again, then I get the quality of earnings that can be done for 15 grand. And that's always a partial scope. That's always a less than motivated company behind it. And let's just be honest, Sean, if I'm an accountant looking at a person ready to make $1 million upside, but they're too short-sighted to want to pay me a full fee, it creates another wonky incentive. And so as an investor, another thing to look at probably earlier in the process as you start dealing with some of these buyers is were they appropriately sort of financed to get a good QoE. And frankly, and I don't want to speak for anyone's pockets, but in a formulaic investment scenario for like self-funded deals, there's a great argument for investors to actually figure out ways to fund or refund buyers so that they do have the full budget for a quality earnings. Because frankly, as an investor, you're going to get a confidential information memorandum put together by a broker, a real fancy, hey, I need some money memorandum put together by the buyer. And if the only conservative, here's the real cash flow thing, is the quality of earnings, and that's compromised, you have 100 pages of data that doesn't tell you the most important thing.
Yeah, it's a great point. And there's kind of talked about this on some other conversations we had, but there's sort of two deal structures almost in the self-funded search and independent sponsor space. And I'd say it's pretty commonplace, as you well know, in the independent sponsor world to have like a diligence reimbursement or a transaction fee at close. And I think, especially when the sponsor is quarterbacking a tremendous deal team that's likely pretty expensive, that makes a ton of sense. That should come out of the sources and uses, right? You're right in that you don't see that kind of transaction fee or diligence fee dynamic as much in the self-funded search world. And, maybe part of that is because there's such larger ownership post-close in general, right? Self-funded searcher is going to own 60, maybe 70%, right, of the business. There's various ways it kind of shakes out through the deal mechanics, but I do think it's a good point, and it's something that investors should be willing to pay for in one way, shape, or form.
Yeah, I don't have the answer for it, which is why I said I won't speak for people's pockets. But I think having been on the investor side, I'm getting a biased packet from a broker, a biased packet from a buyer, and a halfway done packet by a QoE provider. And I'm betting money semi-passively. So I think it may just warrant opening up that. Now, I recognize that in self-funded, one of the frustrations from investors is how much common equity the buyer gets. But as an investor, you're thinking about protecting your investment and minimizing your risk. And so goose eggs create tremendous downside pressure, rough deals that should have sort of been solid in 2 or 3 years that take 10 and then really put your buyer at pressure, really wanting to run this thing. There's a bid ask on that risk that should just be considered.
Yeah, absolutely. Speaking of those kind of couple examples of risks that you've seen, would love to hear maybe 2 or 3 stories that you have of the most, compelling or maybe concerning things you've seen as you've gone through this.
Yeah, I'll give a couple of examples. So I worked with the guy who sold a 7-figure business to Vanguard, the financial company, and then went to go buy a security business, manned security. Funny enough, the broker who represented it waves a flag as having a Harvard finance degree, which I always think is interesting. So we're going through the due diligence and we go through our normal processes. We wanted to check a couple of the receipts because there were invoices that didn't add up to the full amount of the revenue. Well, the first time we asked, oh, well, we got a bunch of paper receipts. We don't have them in QuickBooks. It's a weird system. Like, what do you guys want me to send you? Like 78 boxes of receipts? Like, I can't do that. Okay, so we go back to the drawing board. Second time we ask, hey, don't you have like an office manager that like manages like your back office? Well, can we get them on a phone call to see if we can get a couple of receipts that we can test and move forward? We get the office manager on the phone and they're equivocating, moving around. And then we finally say, hey, look, send us 10 receipts, any ones that you want, as long as they're not sequential, and we'll do the work. And he threw his hands up, he and hawed about the difficulty and data security and all this crap. And essentially what had happened is that the seller had deposited $1 million into the bank, called it revenue. It was just capital he had to make a break-even business look like it was $1 million in EBITDA. And had we not pressed those 3 separate times to get the invoices and then had the fortitude to tell a buyer who has sunk costs that, hey, I'm not 100% sure, but I'm pretty sure that this person deposited money that has nothing to do with the business to make it look profitable, that would have been a complete goose egg. That person would have bought a break-even business for $4 million. That's the kind of stuff that happens out here. And again, does the quality of earnings scope include testing invoices? A lot of them don't. Another example, I had a company, it was a trucking company operated out of the port in Los Angeles. And this is one of the telltale signs. So when sellers have 3 different accounting companies and 2 of them were recently purchased or acquired as vendors, yellow or orange flags are already up. So this company had an internal accounting function that was, of course, underinvested in. That was one. Then they had like 6 months previous hired a group from the Philippines to do remote accounting. And then they had a separate US-based accounting firm that they had hired 3 months previous. And so we played hot potato for 3 months around who knew what data set was correct, who had the best view on this, who had real receipts in terms of what I call is like base documents that came directly from the source. And this was another time after way more work than what's in a normal scope. I had to tell my client, here's the number, but I could tell you 2 or 3 things that could sway this 30 or 40%. I can't recommend the deal. But what was interesting there is just those 3 companies, because why would you need that overlap? It's purposefully to be deceitful. And then related to that, but different, I was helping somebody buy a company in Canada, but it was done through a US brokerage. So we ended up getting the confidential information memorandum from the US-based brokerage. It had financials from a US-based accounting firm hired by the brokerage to adjust the numbers from Canadian dollars to US dollars. Well, when we finally got the financials from the Canadian CPA that had been working with the company for years, they didn't match. Now it took us like 3 or 4 weeks to get the US accounting firm and the Canadian one on the phone together, as you can imagine why. And what ended up happening is the brokerage firm trying to get over had added back things in the general ledger on their reworked, converted to US dollars financial presentation. So all the add backs were sort of mixed in like gumbo in the income statement, very hard to pull out, and just basic numbers, revenue, gross profit, operating profit, EBITDA, did not match, meaning they had added some other add backs that weren't appropriate. And it took us a long time. And frankly, that was one where I think the client actually went through with the deal in a lesser extent. I think they bought a minority share, but it just goes to show that even when things are that sort of obvious, buyers can be biased in that moment.
Yeah, those are some great stories. And, I have to imagine you're kind of the approach that you take and your team takes just compounds in your ability to, recognize these things with some heuristics, right? Which is a real, advantage for folks that have done lots of these, especially in the small business, in the deep lower market, right? Because the risks and whatnot are just so different than they are, as you kind of touched on earlier, than when you get pristine financials and you've got, a professionalized management layer in place.
Then I'll add this. This is also where I think having the deal experience adds such a benefit to the buyers and the investors. Here's why. So I told a story about testing invoices. If I was just an accountant, the story would have ended there, Sean. The reason I understand what happened is because I understand the operations of a business and the deal implications of these things and why somebody would do it and the incentive level that somebody has to do it. And also being able to read the seller and the broker's interaction enough to be able to tell my client what I think actually happened. And so again, this could be some boring email about testing of invoices that's inconsequential or that did not have a conclusion. My words are messing up. And then the second one could have been, oh, well, we just have a reliability of financials issues. The concept of hiring the accounting firms so close to the deal wouldn't have came up. And the reason these things are important to investors, in my opinion, is these are the things that never are part of the top 10 things somebody's going to tell you about a deal. Could sway EBITDA 30%. Once again, you want a comprehensive QoE.
Yeah, and not only sway EBITDA, but it says a lot about the seller too. If there's, these kind of, arguably deceptive practices in place. The first one you mentioned is flat out fraud, right? So you just don't want to be unwinding that after you close a deal.
Great point. Even if the deal has cash flow that's close to what you may have thought it was, do you want to deal with someone who was playing a deceitful game? And then frankly, there's no quality of earnings that's going to catch everything. So we catch as much as we can in a large portion of things, but what else is behind those curtains? On the operational side of the house, on the commercial side of the house, outside of the scope of QoE, but just other things that cause issues, right?
So I guess the last kind of item that would be great to touch on, and you talked a little about this when you talked about the scope, is there enough going into the QoE itself, but are there any kind of heuristics or, maybe tips you can provide investors when they're kind of receiving a quality of earnings from a search or a sponsor? What's the kind of, if you were receiving one, how would you start? Where'd you start? How would you make your way through it? What are the most important things to focus on as an investor?
So a couple of ways to answer that. So I think a spot check answer is, do they do a proof of cash, which is essentially recreating the income statement from the bank statements. The reason that's important, you can't walk in the bank on February 1st with a check and say, hey, no, can you put this on January 31st? So the conservatism of the bank and their unwillingness to lie for anyone gives you a conservative basis to build the financials from a source that won't sway away from what actually happened, because QuickBooks can be manipulated. A lot of us have done it, for good reasons in our companies. The taxes, no one's looking to overpay. So the bank statements provide the only sort of steady Eddie point of view of the business. And a lot of these minimal scope QoEs don't do a proof of cash because it's a lot of work. The second thing that I've seen is if you get a quality of earnings that's 10 pages, your sensor should be going off. The reason why, the work of the quality of earnings, and I'm talking to the person that doesn't understand it as well. If you've seen 50 of these, you already know what I'm talking about. But we break down every single item on the income statement, every single item on the balance sheet, why it's there, how is it swayed. We go back to the general ledger to get to add back. So it's not just, hey, travel expense of $15,000. Well, if they ran that through the balance sheet, it's not an EBITDA add back. The only way you really know that is going back to the transactions in the general ledger. So if you don't have sort of the beefiness, the girth of a solid 30-page report, you can already tell that procedures were skipped. if you're only looking at 2 or 3 charts and sort of what I've seen, just some crazy summary superlatives, really, then you know you're in trouble. And I think that you should be able to understand not just the EBITDA, but in a quality of earnings, you should be able to look at any portion of the P&L in any lens that you would want to look at it and have at least a first level point of view at an accurate level. What do I mean by that? So like revenue and gross margin by product, service, or location, like that should be in there. And you should be able to look at COGS and kind of understand how inventory moves into COGS based on revenue recognition, so that people play a lot of games with inventory. And you guys know that that's a really good thing to make sure it's in there. Or have operating expenses been capitalized or run through the balance sheet to boost EBITDA. And so if somebody doesn't take a deep look at the balance sheet, they didn't get there. And then frankly, we've all seen companies that look good on the income statement and failed the cash flow statement test. So there should be a cash flow statement somewhere in the quality of earnings, because at least you can tell the operating cash flows, right? Financial and investing as well. So those are kind of things to be looking for. Just, I'm not saying that it has to be 30 pages or throw the thing out, but when I see these 10-page reports that just didn't do the scope, or these 15-page reports that just restated QuickBooks, then everyone's their general ledger, it scares me, because that's somebody who bought their bulletproof vest at Walmart and they're going to go out into a war zone and get killed after paying a non-zero amount of money for some protection that wasn't complete.
That's great. Great pointers. Being able to scrutinize, revenue trends, gross margin trends by product, by service, by customer, it's so critical. And it's frankly, it's been rare, at least in my experience in the, micro cap world. It was a lot more commonplace when I was doing larger deals, but I think it's always something we ask for. And when we're able to get it, it's a really nice, way to get a wholesome understanding of the business's profitability, quality of revenue, and whatnot. So it's great feedback, Elliott.
Then I'll toss in, for instance, when you get to the level of cost of goods sold and you can isolate something like raw goods or sort of input material cost, right? And all of a sudden you see that trending down 4% over the past 2 or 3 years, but the main component of the product has trended up over the past 3 years. It's another gut check that you can have if that information is presented. But if COGS is all condensed into one line, not separated, a lot of these smaller companies don't even do cost of goods sold. They put everything in operating expenses. So if somebody hasn't right-sized that, these are just simple checks that like a smart investor would say, what the heck? There's no way steel went down 5%, in the past 4 or 5 years. But if you don't get that level of granularity in the report, you wouldn't see.
And then you got to triangulate that to the inventory checks, like you said, right? So that's how you're always, making everything tie out, just like a good, set of financial statements should, right?
That's it. We're providing a good set of financial statements, given pretty terrible garbage in inputs most times, with a smile on our face and a disposition to being happy to do the work.
Oh, that's a great value proposition, Elliott. So again, appreciate you taking the time. Anything else you want to highlight before we hop off?
I would just say that I put on a lot of content for the consumption of people who want to know more. Between my webpage and YouTube, there's just a lot of stuff out there. I think there's a lot of educational stuff, even for people who are knowledgeable, because a lot of the stuff I didn't learn in private equity, I learned doing these quality of earnings deals. So I would just say that no matter where you are on the spectrum of knowledge, don't cheat yourself. If there's some stuff you want to go learn, it's probably out there on my website somewhere.
Awesome. Well, thanks again for chatting with us, and we'll see you later.
See you later, Sean. Thank you.